3 weeks ago, mining power had slipped 7%, and the network was heading toward a modest June 12th adjustment. On Sunday, June 15th, the chain printed something larger. Difficulty fell 10.09% in a single epoch, the 11th biggest downward move in Bitcoin's history. Galaxy Research called it capitulation on June 21st. Not a strategic exit, but a forced one. And today, the chain counts the blocks since that drop and writes new mining rules. No vote, no hearing, and no press release. Mining is a conversion problem dressed up as a competition. Electricity goes in, heat comes out. The machine's job is to produce guesses that satisfy the network's target. When the price of Bitcoin falls and the reward per guess stays fixed in protocol terms, the revenue per unit of electricity falls with it. Operators running the oldest machines on the most expensive power hit the wall first. They unplug. The guesses stop. The network notices because blocks start arriving slower than the 10-minute target. That is the thermodynamic layer underneath the price chart. Margin pressure is not a sentiment story. It is a physics story. Machines that cannot pay their power bill go dark. Bitcoin's code does not ask why Hashrate fell. It only measures how long the last 2016 blocks took. If they took too long, difficulty drops, so the next 2016 are easier to find. If they come back too fast, difficulty rises. The loop has run more than 470 times since the Genesis block. It does not pause for earnings season. It does not wait for Galaxy Research to publish a note. The June 15th adjustment landed at block 953,568. Difficulty moved from 138.96 trillion down to 124.93 trillion. That single step was the second largest drop of 2026. Combined with earlier declines this spring, difficulty now sits more than 20% below its November 2025 peak. Galaxy Research compared the peak-to-trough move to the period after China's mining ban in 2021. Different cause, same automatic response. Network hash rate followed. Total mining power is down roughly 12% in June and about 23% from October's peak, depending on which 7-day average you look at in the data. JPMorgan estimated that about 20% of the sector was unprofitable with spot near $64,000, with production costs near $78,000 for some operators. Public mining companies sold a record 32,000 Bitcoin in the first quarter alone. Treasury coins leaving balance sheets to pay bills when the market would not fund them through equity. For the miners still running efficient fleets, the June 15th drop brought a partial reprieve. Hashprice, revenue per unit of hash rate per day, climbed back above $30 per petahash. Less competition means a larger share for the fixed block subsidy for whoever stays plugged in. That is not a relaxed market. It is a less crowded one. Some of the unplugged capacity did not leave the data center business entirely. Across North America, operators with power contracts have been repointing shelves toward artificial intelligence workloads where the customer pays for the compute differently. That shift shows up in hash rate charts before it shows up in earnings calls. Today's adjustment captures the Bitcoin slice of the story, not the AI slice. The Retarget landing today is the first full epoch after that capitulation drop. Public estimates bracket the outcome. Some models show a small positive adjustment, a few tenths of a percent, which would mean hash rate stabilized, but did not fully return. Others project closer to 5% upward, which would mean enough machines come back online that blocks arrived faster than the target over the closing window. The number itself matters less than what it signals. A flat or slightly positive print after a 10% cut says the cleanup may be finding a floor. A larger positive jump says marginal capacity is returning because economics improved. A surprise negative would say stress is still forcing machines off faster than the last adjustment accounted for. None of those outcomes requires permission from a central bank, a mining council, or a treasury department. The chain measures block times. The code updates the target. The next block mines under the new rules. Set against fiat monetary systems, the asymmetry is quiet but sharp. When credit tightens, policymakers debate. When miner margins squeeze, Bitcoin's supply schedule does not convene a committee. The subsidy still pays 3.125 Bitcoin per block at the current epoch. The 21 million cap has not moved. The adjustment is the pressure valve, and it is automatic. For a long-term holder, the retarget is not a trading signal. It is a health check on whether the security budget, the energy and hardware committed to finding the next block, is stabilizing after a forced shakeout. The chain has survived larger disconnects before. The question today answers is narrower. Did Hashrate stop falling? A capitulation story is about who left. The retarget is the network's answer to the departure. And blocks keep arriving whether miners are cheerful or going broke. When they arrive slower than the 10-minute target, difficulty falls. When they speed up again, difficulty rises. That loop has run more than 470 times since Genesis. Today is another count of timestamps and another rewrite of the mining target. The unplugged rigs do not vote on the outcome. The block times do. So, is capitulation bad for Bitcoin holders? It is painful for operators who unplug, and it can add sell pressure when treasuries liquidate coins to pay bills. For the network layer, capitulation is the mechanism working. Inefficient hash rate leaves, difficulty drops, survivors earn more per machine until balance returns. The security model assumes margins fluctuate. The code assumes adjustments. So back on June 7th, we walked the engineering loop when hash rate had slipped 7%, and the June 12th adjustment was still ahead. The June 15th drop was larger, 10.9% in one epoch, and Galaxy's June 21st note named it capitulation. Today's retarget is the first look at whether that larger drop stabilized the network or is still underway. So should holders expect the adjustment to be exactly plus 5% or plus 0.3? Projections are estimates from block time still arriving. Verify the realized number after the epoch closes. The range across public models is the point. The market has not fully decided whether hash rate is returning. Does miner selling affect the adjustment? Indirectly, yes. Coin sales pressure price, which pressures margins, which pressures hash rate, which changes block times, which changes difficulty. The chain does not track treasury filings, it tracks timestamps on blocks. And what if the difficulty rises sharply today? That would mean enough hash power return the blocks came in faster than the 10-minute target over the window. A sign marginal economics improved enough to bring machines back. It would not mean the June slide never happened, it would mean the network is responding to the response. So there you have it. The chain rewrites the mining target today, and the question is whether the unplugging stopped. Thanks for showing up for this one. It means a lot to us. The channel will keep tracking the realized adjustment print, hash rate trajectory through July, and whether public miners keep selling treasury coins into the recovery. Subscribe and hit the bell to stay in the loop. Take care, everyone. We'll see you on the next one.